Let's dive into a topic that might sound a bit dry at first, but is absolutely crucial for anyone involved in accounting, manufacturing, or even running a small business. Today, we're talking about absorption costing. Now, before you roll your eyes and think, "Oh great, another accounting term," let me assure you that understanding this concept can make a world of difference in how we view costs, pricing, and ultimately profitability. So, what is absorption costing? Simply put, it's a method of accounting that includes all manufacturing costs, both fixed and variable, when calculating the cost of a product. This means that when you're determining how much it costs to make something, you're not just looking at the direct materials and labor. Nope. You're also factoring in things like rent, utilities, and other overhead costs that are necessary to keep the manufacturing process running smoothly. This method is also known as full absorption costing, and it's a big deal because it helps businesses get a complete picture of their costs. Now, why does this matter? Well, think about it. If you're running a business, you want to know exactly how much it costs to produce your product so you can set the right price. If you only consider direct costs, you might end up underpricing your product, which can lead to losses. On the flip side, if you overestimate costs, you might price yourself out of the market. Absorption costing helps strike that balance by ensuring that all costs are accounted for. Let's break it down a bit more. When you look at your inventory under absorption costing, you're seeing a more comprehensive view. You start with direct materials. Those are the raw materials that go into your product. Then you add direct labor, which is the cost of the workers directly involved in making your product. But here's where it gets interesting. You also include variable manufacturing overhead. These are costs that fluctuate with production levels, like utilities and supplies. And finally, you add fixed manufacturing overhead, which are the costs that stay the same regardless of how much you produce, like rent for your factory. Now I know what you're thinking. Isn't that a lot of numbers to juggle? Yes, it can be. But the beauty of absorption costing is that it gives you a clearer understanding of your product's profitability. When you sell a product, you can see how much of that sale goes toward covering all your costs, not just the direct ones. This comprehensive approach is essential for making informed business decisions. But hold on, it's not all sunshine and rainbows. There are some drawbacks to absorption costing that we need to discuss. For one, it can sometimes lead to inflated profits. How? Well, if a company produces more than it sells, the fixed costs get spread out over a larger number of units, which can make it look like the company is more profitable than it actually is. This can be misleading, especially if management makes decisions based on these inflated numbers. Let's say you're a small business owner producing widgets. You make 10,000 widgets in a month, but you only sell 8,000. The remaining 2,000 widgets still have costs associated with them. But because you spread your fixed costs over all 10,000 widgets, it might look like your company is doing great on paper. In reality, those unsold widgets are just sitting there, and you've got to consider the cost tied up in inventory. Another thing to keep in mind is that absorption costing can complicate financial analysis. When you're trying to assess your business's operational efficiency or compare different product lines, the way costs are allocated can cloud the picture. It's essential to know not just how much you're making, but how efficiently you're operating. Now, let's talk about the relevance of absorption costing in the real world. For many businesses, especially those that must comply with generally accepted accounting principles, or GAAP, absorption costing is not just a choice, it's a requirement. It ensures that all production costs are accounted for, giving a more accurate picture of financial health. This is particularly important for external reporting, where stakeholders want to see a complete view of a company's financial situation. So, how do you calculate absorption costing? It's pretty straightforward. You take your total direct labor costs, add your direct materials costs, include your variable manufacturing overhead, and then factor in your fixed manufacturing overhead. Divide that total by the number of units produced, and voila! You've got your absorption cost per unit. This number is crucial because it helps you determine how much you should charge for your product to cover all of your costs and hopefully make a profit. Let's illustrate this with a quick example. Imagine you run a small bakery. You bake 1,000 loaves of bread in a month. Your direct materials cost is $1 per loaf, your direct labor cost is $0.50 per loaf, and your variable overhead, let's say for utilities and ingredients that fluctuate, is $0.30 per loaf. On top of that, your fixed overhead costs, like rent for your bakery, total $500 for the month. So, here's how the math works out. Direct materials, $1,000, direct labor, $0.50, variable overhead, $0.30. Fixed overhead, $500, 1,000 loaves, equals $0.50. When you add it all up, your absorption cost per loaf is $1.60 plus $0.50 plus $0.30 plus $0.50, so in $2.30. Now, if you sell your bread for $3 a loaf, you can see that you're covering your costs and making a profit. But if you only consider the direct costs, you might think you're doing better than you actually are, which can lead to trouble down the road. And let's not forget about tax implications. The IRS has specific rules about what costs can be capitalized into inventory for tax purposes. Absorption costing helps businesses align their financial reporting with tax requirements, ensuring they're not missing out on potential deductions or misrepresenting their financial health. In conclusion, absorption costing is more than just an accounting term. It's a vital tool for understanding the true cost of doing business. It helps you price your products correctly, manage your inventory effectively, and provide a clearer picture of your profitability. While it has its drawbacks, the benefits of using absorption costing, especially in compliance with GAAP and for accurate financial reporting, are significant. So the next time you hear someone mention absorption costing, don't tune out. Instead, think about how it applies to your business or your understanding of financial health. Whether you're a seasoned accountant or just starting in the business world, grasping this concept can empower you to make better decisions, optimize your pricing strategies, and ultimately drive your success. Now, let's keep the conversation going. What are your thoughts on absorption costing? Have you used it in your business, and how has it impacted your financial decisions?